We recently released our biannual U.S. Market Insights, a quantitative perspective on U.S. private markets. Over the next few minutes, we'll walk through the latest data and trends shaping private equity and venture capital, the exit environment, and what the future holds for the private capital industry. We'll first begin with deal making. Across both private equity and venture capital, there's been a little bit of a reset, and the scarcity of exits has weighed down on fundraising and slowed the pace of new deals. For private equity specifically, deal activity and exits remain subdued compared to historical highs. As the charts show, both deal activity and exit value have started to drift back towards long-term historical trend. This suggests that the worst of the slowdown may be behind us, though activity is not fully back to normal. Due to the slow exit environment, portfolios are aging. The median holding period for buyout-backed companies is extended well past historical norms, and about a third of the current buyout-backed universe has now been held in portfolios for at least 5 years. This trend creates a backlog. GPs are managing older assets for longer, while LPs are waiting longer for distributions. Another factor slowing exits is the elevated entry multiples paid in recent years. The data here shows that the most expensive buyout deals, those in the top quartile of EV to EBITDA multiples, have had the lowest exit rates. This has compounded the problem. Deals struck at higher valuations are harder to sell in today's higher rate environment. The net effect is that capital is locked up in funds for longer. As shown here, more than 1/3 of private equity net asset value is now held in funds at least 7 years old. That's a big shift from post-GFC years, and it underscores how delayed exits have slowed capital recycling across the industry. Turning to venture capital, these trends have been even more pronounced. Deal activity is starting to edge closer to long-term historical trend lines, but like private equity, the market remains in reset mode rather than in full rebound. Exit activity has improved slightly, and we've seen some high-flying IPOs that has got the market excited. We've seen high valuations for AI startups, for example, but there's still a huge backlog of portfolio companies, and there's a lot of pressure on GPs to return capital back to their investors. Just like its buyout-backed counterparts, the net effect of the slow exits in venture capital portfolios is shown in the growing backlog of aging unicorns. Aggregate unicorn valuations now approach $3.4 trillion. And more than 60% of active unicorns are over 7 years removed from their first venture round. Many of these companies would have normally exited, but they remain private, adding to the logjam. As a result, both private equity and venture capital funds are showing net asset values that extend well beyond historical trajectories. Realizations have slowed, which delays distributions back to LPs and stretches out fund timelines across the asset class, and that means that LPs can't commit more capital to future vintages as they remain at or above target allocations. All of this is happening in the context of a stable yet uncertain macro backdrop. As we entered the year, the market was expecting economic growth to pick up and the Fed to have plenty of room to lower policy rates. As we've gone through this year though, uncertainty introduced by tariffs and geopolitical concerns have left the economic environment in a bit of a limbo state. Still, if the present environment holds, the stage is set for a gradual reset in valuations and deal activity. While we wait for the exit environment to continue to improve, the secondaries market has emerged as a critical relief valve. In 2024, secondary transactions hit a record $160 billion, with $71 billion coming from GP-led transactions. As we can see here, GP-led deals are now a mainstream tool for providing liquidity, often through continuation funds. This trend has carried into 2025, which is setting up for another record. In venture capital, the market for company shares in the largest, most successful startups has exploded, totaling tens of billions of dollars in volume this year. And elsewhere, we are seeing dedicated pools of capital targeting assets in private credit, real estate, and infrastructure. So that's where we are today. The next question is, where do we go from here? Despite today's challenges, the long-term trajectory of private markets remains one of expansion. The next growth wave is already taking shape. Our forecasts show North American private capital assets under management growing from $11.5 trillion in 2024 to over $16 trillion by the end of the decade. While traditional drawdown funds will continue to play a dominant role, we're seeing rapid expansion of evergreen and semi-liquid fund structures. Today, there are more sponsor-backed private companies in the US than publicly listed firms. Yet in terms of total market capitalization, private equity and venture capital combined still only represent a mid-single-digit share of the public equity universe. This highlights just how much room remains for growth as investor access broadens. A key driver of that access has been the growth of interval and tender offer funds. As this chart shows, 2025 is on pace for a record year for new fund launches, reflecting the rising demand from private wealth investors for exposure to private markets and GPs' willingness to meet that demand with new products. Excitement about the possibility of 401k plans opening up private assets has many big players in the industry gearing up with partnerships. And when we look further ahead with those tailwinds, evergreen fund structures are set to surpass $1 trillion in assets before 2030. These vehicles are growing at a 20% annual rate, with strong demand across private credit, private equity, and real assets. This wealth-driven capital base represents the next frontier for private markets, but investors should be mindful of the drawbacks of these semi-liquid vehicles when wrapped around illiquid assets. We have several projects underway to explore the implications of these fund structures in detail later this year. So to summarize, private markets are still working through a reset. Deal-making is improving, but exits remain slow, and that's created a significant backlog that we still need to work ourselves through. At the same time, new sources of capital, particularly through private wealth, are setting the stage for the next growth cycle. You can read more about these trends in the full report. You can also find more research at PitchBook.com.